Welcome back to the deep dive. For our listeners, you know we love getting into the real details behind the headlines.
That's right.
And today on our Top Ticker segment, we're unpacking the recent Q2 2025 earnings from Flowers Foods.
A big name in baked goods.
Absolutely. You sent us the reports, and well, it looks like they're navigating some pretty choppy waters, wouldn't you say? A real shift in how people are buying bread and snacks.
Definitely. They themselves are calling it a generational shift, which tells you something. It's not just a blip.
Okay, so let's start with the top line numbers. What did the results actually show for Q2?
Right. So net sales came in at $1.243 billion. That's actually up 1.5% compared to last year.
Okay, up 1.5%. Sounds all right on the surface.
Well, yes, but here's the catch. That figure actually missed the market consensus. Analysts were expecting a bit more.
Okay. So growth, but maybe not the level of growth Wall Street wanted to see.
Exactly. That was the first sort of yellow flag for investors.
Got it. What about profitability then? Did that follow the same pattern?
It was a bit of a mixed signal, actually. Their adjusted diluted EPS, that's earnings per share, adjusted for certain items, came in at $0.30.
30 cents. How did that stack up?
That actually beat the analyst consensus slightly.
Oh, interesting. So they missed on revenue, but beat on earnings.
Yes, and it's pretty significant, but that $1.30 was still down 6 cents from the previous year.
Okay, down 6 cents year over year. And the GAAP EPS, the reported number.
It was $1.28, which was also down by 4 cents. So yeah, beating expectations, but still showing a decline in profit per share.
It definitely paints a complex picture. What about other profit metrics like EBITDA?
Yeah, just EBITDA earnings before interest, taxes, depreciation, and amortization, it landed at $137.7 million.
And the margin, that's always key.
That's where you really see the pressure.
Yeah.
The adjusted EBITDA margin slipped 60 basis points compared to last year. It came in at 11.1%.
60 basis points, so 0.6%. That confirms the pressure on profitability, right?
Absolutely. It means it's costing them more to generate those sales. Their core operational efficiency took a hit.
And you can see that directly in the cost of goods sold, I assume.
You can. Production costs jumped 110 basis points year over year, climbed to 51.2% of sales.
Wow, over half their sales just going into production costs. That's significant.
It is. It shows those rising cost pressures are really biting.
So, understandably, the market reaction wasn't great.
No, the immediate sentiment was pretty clear disappointment. Investors seem more focused on the revenue miss and the margin pressure than the slight EPS beat.
Right. So let's dive deeper then. What are the main headwinds causing these issues? You mentioned softness in bread.
That's the core problem, really. Traditional loaf bread sales are weak. Overall volume in bread declined 2.4%, which is already concerning.
Okay.
But traditional loaf specifically, volume dropped 6%. That's a big hit to their main category.
6% volume drop. Is that just market decline, or is competition playing a bigger role now?
It's definitely both, but competition has really intensified. We're seeing a lot of new, lower-priced breads hitting the shelves.
The value play.
Exactly. And that's directly hitting Flowers' traditional loaf segment.
Right.
Sales there were down 7.9% in dollars this quarter.
Worse than Q1, wasn't it?
Yeah, it actually worsened from a 5.5% decline in Q1. So the pressure is building, not easing.
And you also mentioned broader consumer shifts. People just aren't buying the same stuff.
Right. There's a definite move away from some of those traditional center store packaged goods, like bakery items.
Where's the money going instead?
Two main directions, really. Either towards differentiated products, things perceived as better for you, maybe organic, keto, that sort of thing, or towards pure value options.
And also towards the perimeter of the store, right? Fresh stuff.
More spending on produce, proteins, dairy, less on the center aisles where traditional bread lives. It's a fundamental change in shopping patterns.
How does inflation factor into this? Are different income groups reacting differently?
It's quite interesting, actually. You have higher income shoppers who are, believe it or not, increasing their total food spending. But crucially, they're cutting back specifically on bread purchases, maybe trading out for other things.
And lower and middle income shoppers?
They're feeling the price pinch more directly. So they're reducing the number of units they buy overall because prices have gone up. Fewer loaves, fewer snacks.
So pressure from both ends, just in different ways.
Precisely. And beyond those big trends, Flowers also mentioned some specific operational things hitting margins.
Like what?
Well, increased costs for outside purchases, partly related to integrating the Simple Mills acquisition, co-manufacturing costs,
Okay.
and higher workforce and fleet expenses, especially from converting territories in California That added pressure.
Right. Those operational changes can be expensive up front.
They can be.
Yeah.
And apparently there was even a cyber attack at UNFI, one of their distributors, which had a bit of an impact on Simple Mills results too. Just another headache.
Okay, so a whole raft of challenges. The big question then is, what's the strategy? How does a giant like Flowers Foods fight back?
Well, their main push is transforming the portfolio, shifting the mix away from those challenged traditional areas.
Towards the higher margin stuff.
Exactly. Higher margin branded retail products, those now make up 67% of their sales. That's up from 64% a year ago. It's a deliberate move.
And innovation must be key here.
Huge focus. And they have some real bright spots. You look at brands like Dave's Killer Bread, DKB, and Canyon Bakehouse, the gluten-free brand.
How are they doing?
They're performing incredibly well, actually. DKB grew unit sales by 4% and Canyon Bakehouse by 12%.
12%.
In this market.
Yeah, even while the overall bread category was shrinking, it shows there's strong demand for those specific types of differentiated products.
Yeah. Oh, that's impressive. Are they innovating outside of bread too?
Definitely. Nature's own keto products are doing well. DKB has protein bars and snack bites that are performing strongly.
Tapping into those health trends.
Precisely. Organic category sales are up 3%. Keto's up 4%. They're aligning with where the growth is.
What about that Wonder Cake launch? I saw notes on that. Well, yeah, that was quite successful. They launched it nationally, and apparently it outperformed the cake category significantly.
Did it steal sales from Tasty Cake?
That's the clever part. They said it gained 70 basis points of unit share without cannibalizing Tasty Cake. So, incremental growth.
Smart. And adapting pack sizes, too. Smaller loaves.
Mm-hmm. Catering to smaller households and also hitting a different price point for value shoppers, trying to cover multiple bases.
And the Simple Mills acquisition, that seems pretty central to this whole better for you push.
Absolutely central. In Q2 alone, Simple Mills added $61.4 million in sales and nearly $11 million in adjusted EBITDA.
And it's outperforming.
Yeah, outperforming both the total category and the natural category, especially in crackers. So it's hitting the marks they wanted.
Okay, so portfolio shift, innovation.
Yeah.
What about costs? Are they tackling that side?
Management says they are laser focused on cost. That was the phrase they used.
Sounds serious. What does that mean in practice?
Implementing additional savings initiatives. Things like labor efficiencies, other operational tweaks. They expect these to really start helping in the second half of the year.
Okay.
They're also working on optimizing margins in their non-retail business, like food service, where they said the price mix has actually improved a bit.
Good. Any big operational projects still ongoing?
Yes, the ERP system rollout. That's a huge, complex project for any company.
Enterprise resource planning, right. Integrating all their systems.
Exactly. They just completed the third bakery conversion successfully, and they've got more planned for Q3. It's slow going, but essential for long-term efficiency.
Right. Foundational work. Okay, so given all this, the headwinds, the strategies, they adjusted their outlook for the full year, correct?
They did. They lowered the guidance for fiscal 2025, reflecting these ongoing challenges.
What are the new numbers looking like?
Net sales are now projected between $5.239 billion and $5.308 billion.
Okay.
Adjusted EBITDA guidance is now $512 million to $538 million. And adjusted EPS expected between $1 and $1.10.
So noticeable cuts across the board from previous expectations.
Definitely. It signals they see these pressures persisting through the year.
Now, does that guidance include any one-offs or specific contributions?
It does. It includes the benefit of an expected 53rd week in their fiscal calendar this year.
The extra week effect. How much does that add?
They estimate about $70 to $80 million in sales and $5 to $7 million in adjusted EBITDA, just from that extra week.
Okay. And the Simple Mills contribution for the full year?
That's baked in too. Expected to add around $218 to $225 million in sales and $30 to $33 million in adjusted EBITDA for the full fiscal year.
So even with those boosts, the overall guidance had to come down, really highlights the pressure on the core business.
It really does. One small positive note, though, they significantly lowered their estimate for the impact of tariffs in FY25.
Oh, why is that?
They didn't elaborate much, but it provides a tiny bit of relief, just not enough to move the needle significantly against the other headwinds.
Understood. So let's talk capital allocation. With profits under pressure and the Simple Mills deal done, what are their priorities for cash?
The number one priority they stated is getting leverage back down, paying down debt.
What's the ratio now?
It's running at about 3.2 times net debt to trailing 12-month adjusted EBITDA. That's up because of the cash used for the Simple Mills acquisition. They want that lower.
Makes sense. What about shareholder returns, dividends, M&A?
Well, the board did recently raise the dividend, which is interesting.
Yeah, despite the earnings pressure.
Yes, but management also acknowledged that the gap between the dividend commitment and their current earnings per share is narrowing.
Cutting it a bit fine, perhaps.
Potentially.
Yeah.
And on M&A, mergers and acquisitions, they still say it's a strategic priority long term. But
debt pay down comes first for now.
Exactly. They suggested any future large deals would likely be over time, maybe using stock instead of cash, because the immediate focus is deleveraging. So don't expect another Simple Mills-sized deal right away.
Okay, that paints a clear picture. So summing up the market reaction.
Negative, right? Stock down.
Swift and negative. The stock dropped over 5% on the announcement day, and trading volume spiked.
So investors clearly focused on the revenue miss, the soft demand, the competition, more than the EPS beat.
That seems to be the takeaway. The underlying trends in the core bread business and the competitive heat seem to be the main concerns.
And the stock's performance overall hasn't been great recently.
No, it's significantly underperformed the broader market and even other consumer staples companies over the past year. The market's showing its concern.
So what's the signal the market is sending? What do they need to see?
It seems like the market needs tangible proof that the cost savings and the portfolio shift, like DKB and Simple Mills, can actually gain enough traction to offset the decline in the traditional business.
They need to see the turnaround take hold visibly.
Exactly. Management keeps talking about this generational shift, which implies it won't happen overnight. They're asking for patience, but the market seems a bit impatient right now. It's a classic show me, don't just tell me situation.
Pretty much.
All right, well, this feels like the perfect time for our not financial advice segment, where we toss around a, let's say, creative trade idea based on what we've just discussed. Purely hypothetical, of course.
Always hypothetical.
Okay, I'm ready.
Given this deep dive into Flowers Foods, the pressures on traditional bread, that clear split towards either better for you or pure value, how about this for the adventure speculator out there?
Lay it on me.
We call it the niche health revolution arbitrage. It's a pair trade.
Okay, pair trade. Long one, short another.
Right. First leg, you short Flowers Foods, FLO is the ticker. You're betting that the challenges in legacy bread continue, and turning that big ship around takes a long, long time.
Betting against the incumbent navigating the shift. Makes sense conceptually. What's the other leg?
The other leg, you go long, a private company. Find a fast-growing, maybe artisanal, keto-friendly cracker company, something small, nimble, not public yet.
Whoa, okay. Long a private niche player, that's definitely adventurous. It's an extreme bet, right? You're betting the market completely jumps over the transition phase of big players like Flowers and goes straight to these focused, high-margin, health-conscious brands.
So you're bypassing the whole transformation story of Flowers and betting purely on the future niche winners.
Exactly. It's a pure play on where you think consumer tastes are ultimately heading, not just how existing companies are adapting. Again, highly speculative, not advice.
Definitely not advice. But it does capture that dynamic we discussed, the hollowing out of the middle and the growth at the premium niche end.
A very bold thought experiment.
It is. Okay, so let's wrap up our Talk Tickers deep dive on Flowers Foods Q2.
Yeah, it's clear they're in the middle of a really complex transition, juggling declining core products with promising growth areas.
Actively trying to reposition that portfolio towards those higher margin, differentiated brands like DKB and Simple Mills, while fighting fires in traditional bread and controlling costs.
It's a tough balancing act.
The big question hanging over them, especially with management talking about a generational shift, is speed, isn't it? Absolutely. Can that strategic pivot, the innovation, the cost cuts, can it gain enough momentum quickly enough to visibly outpace the decline in the old core business?
And convince a market that seems pretty skeptical right now.
That's the multi-billion-dollar question. It's going to be fascinating to watch how this plays out, not just for Flowers, but as a case study for the whole food industry.
Agreed. Well, thanks for tuning in and taking this deep dive with us. We really encourage you to keep exploring these market dynamics yourself.
And just a reminder, all this information is purely for educational and informational purposes. It is definitely not financial advice.
We'll be back soon with another deep dive.